Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, let's talk about investing directly in the commodity itself, investing directly in natural gas. Once again, you could use futures levered or unlevered. Let's say, for example, that you want to have $40,000 worth of natural gas exposure and you don't want to be leveraged at all. You can just go long one futures contract of natural gas and you'll have that. There's no leverage involved. You'll never get a margin call. It's just like buying $40,000 of natural gas. One thing with which you need to be aware of when doing that, though, futures is a different ballgame. You need to be rolling your contract every month. You need to be aware of the fact that there's going to be contango issues, meaning the price the next month might not be the same as the price the current month. You could also use UNG. You need to be aware of the issues that go along with that, as we discussed earlier. Or you could physically buy the commodity itself. Go down to Ace Hardware, buy a bunch of propane tanks, and just kidding. So with that, there's ways with which you can invest directly in it. For some people, that's what makes the most sense. For other people, it might not make as much sense. Now, what about investing in natural gas stocks? And we'll show you a little bit of some ways with which we like to do that at Know Your Options, but the questions with which you need to ask yourself, is it a good company? And we're talking about for investing purposes, not for short-term trading purposes. How's the company fared when natural gas is not doing well, like it hasn't recently? How diversified are you? Just like I was saying earlier, have a good understanding of what the company is doing itself to make sure that you're invested in a natural gas company and not just an oil company that maybe does some natural gas every now and then. And then you need to make sure you have a firm understanding as to what strategies with which you can use. Should you buy the stock? Should you do a cover call? Should you do a spread? Should you buy a leap? What is the best strategy for your individual situation? So we have three basic ways with which we like to trade natural gas stocks. The first one's pretty simple, owning a stock. Not going to spend any time demonstrating how to do that. Just go to your online broker, click buy, and then you own the stock. We'll be going over how we select any of these three strategies a little bit later on in the webinar, but I want to kind of give you an idea of how we like to do it. Next, you can sell a put to get into a stock. Let's say that XYZ stock is trading at $53, and we're comfortable buying the stock at $50, but we don't want to just put in a limit order at $50, because what if it stays the same, or what if it goes up a little bit? We don't want it to be dead money, so to speak. So we like to sell puts at lower levels to get into the stock. We will get some income, and if we want, we can actually get paid to get into the stock. Not if we want, we will get paid to get into the stock. Now keep in mind, and you'll get paid by the premium you sell at the 50 call or the 50 put level. Keep in mind that might not be the right way to go, but it's another strategy with which we like. Next, we have the calendar combo. This is one with which we've been using quite a bit lately, and we've been pretty excited about it in this bull market. Now, is it going to work all the time? No, nothing ever works all the time. The only thing that always works all the time is, well, I don't know what always works all the time. I've never run into such a strategy. My point is that the calendar combo is just one tool that exists within a toolbox. It's important to have an understanding as to how all of your tools work. So, what is the calendar combo? Calendar combo is an area where we like to go out about 6 months and buy an out-of-the-money call option. This strategy, kind of the etiology of how I put this into my own personal toolbox, is that I was just getting too darn frustrated with selling covered calls and getting called out month in, month out. And with that, I also like the idea of selling premium. I like the idea of selling near-term premium in relation to long-term premium. So this is kind of what I came up with, or what we came up with at Know Your Options, as a way of being able to be a premium seller, but not get that typical covered call frustrated mentality when the stock goes up too much. So what we'll do is we sell an out-of-the-money put option front month to try to finance the cost of the out-of-the-money call option. Now, what I'm going to do is bring up the Brokers Express website, and I'm going to show you an example as to how we like to do this using FCG. Now, first off, full disclosure, we're not in this exact position right now. This is something to where we may or may not get into it within the next few days just based upon the market conditions. But I can tell you, trader to trader, we do a lot with natural gas stocks, and FCG is something with which it's on our radar screen. We just have different reasons as to why we may or may not buy it. It depends on your individual risks, your individual goals. But FCG is a product itself. I don't like it. I love it. I think it's a great thing. I love the method with which they do that. And it's a stock it's an ETF that I look at every day, and I'm not able to say enough good things about. So let's take a look at the website. And what I'm going to do is share my desktop. All right. You guys should be seeing the Brokers Express website and an option chain on FCG. Is that what you guys are seeing right now, Steve? If not, please chime in. If you are, then I'll assume that.
Yeah. So one bit of disclosure that I would like to add is that the bid-ask spreads, I think, are much wider now than they were at the close. I don't think that these are really indicative of the markets that you can trade, because I see these markets are pretty wide. I think one or two of the market makers pull their quotes, so the quotes aren't really indicative of what you can do tomorrow at 9:30 Eastern Time. Go ahead, Mike.
Yeah, and that's one, too, just as a market participant, I'll agree with Steve on this. I look at this pretty much every day, and so Steve, if you take a look at these same spreads tomorrow as well during market hours. It's just that after hours, you just kind of go with it and bear with us with the demonstrations. But on here, let's say that we are bullish on natural gas, and we like the idea of investing in stocks. We're not too keen on investing in the individual stocks, but we want to look into a way with which we can be diversified, have natural gas exposure, have fundamental rules to where we're actually having stocks in our portfolio that have various price-to-book ratios and have a few things with which we like before we actually get into the stock itself, and we want to have natural gas stock exposure. Now, we had a question that came up, why not just do a diagonal call spread on this? Well, the reason with which we're not doing diagonal call spreads right now, and let's pretend that today didn't happen because of the fact that I wrote this webinar before today, because we might go back to a diagonal call spread based on today. I don't know. I would still need to do some analysis on it, but let's just pretend today didn't happen. Let's say that you believe that the stock is going to go higher, and you like the idea of selling premium. Well, if that's the case, if you're selling a call against your call option, meaning that let's say you buy, in this case, a September call option, if you're selling March premium against it on the call side of it, then you're limiting your upside. And in this case, with this example, we like to look at natural gas as kind of not necessarily a wild card, but something that can really get high, in that we think it's going to, this is an area of our portfolio with which we're being a little bit more aggressive, so we don't want to limit the upside so much. Now, granted, there's ways with which you can adjust diagonal spreads, and there's been countless webinars done on how to do that, but for today, I just want to show you what we've been doing as a technique that we like to use in the natural gas stock market. So on here, let's say that we like natural gas, we're bullish on it. I see it's trading at 21.10. And with that in mind, let's say that I think it's going to go significantly higher. I think it's going to go to 25, 30, 40, 50, 300, whatever. I don't really think that, but let's just pretend I think it's going to go up fairly significantly. On this, you can see that the 22 call option is trading at $1.05 by $1.95. So let's just split that. And once again, these bid-ask spreads, you can drive a truck through right now. But in reality, during the market hours, it's not going to be this wide typically. So let's just use $1.50. Let's split that. Let's say that we can buy this 22 call option for $1.50. Now, the good news about that, we have our upside from 22 to infinity, and our downside is limited to $1.50. The bad part about doing just that call option trade is the fact that we have time decay that's going to be working against us. And with time decay working against us, it kind of puts a damper on your spirits should you go to a sideways market. So what can we do? Well, we're of the school of thought that we're fine owning the stock, meaning if it comes down a little bit, we're happy to own it. So what we'll do, let's go to March. Now make a mental note, we paid $1.50 for that 22 call option. So by paying $1.50 for that 22 call option, what are some things with which we can do? Well, the 21 put option, right now it's trading at 40 by 55 cents. And let's say that we get 45 cents for selling this put option at the 21 level. What we've created is a combo, C-O-M-B-O, meaning we've sold the put to help finance the call option. Now, with that being said, let's say that the stock stays the exact same. We get 45 cents this month, 45 cents the next month, and we'll assume volatility stays the same as well, and maybe we get a little bit of a volatility bump in the next month, we'll get 60 cents. My point is that after 3 months, these puts that we're selling finance the cost of that call with which we bought. So if the stock stays the same, then after 3 months, you can say, and once again, this is a oversimplified Candyland example, if the stock stays the exact same, after 3 months, you have a free call option essentially for the whole summer. Expiration is until September. So the question then becomes, what if the stock goes down? What if the stock goes higher? Well, if the stock goes down, you're going to own the stock at $21 should it go below the 21 level. Granted, your cost basis will be $21 for the stock plus an extra $1.05 or whatever the cost basis was on the call minus the premium you took in from the put. But with that in mind, you can then continue to sell covered calls at the 21 level, to continue to try to finance that 22 call. You can do a lot of different things for the purpose of trying to finance the cost of that 22 call. Now, ultimately, if the stock goes down, you're going to lose money on this. There's no ifs, ands, or buts about it. This isn't a hedging strategy. This is a strategy with which you're trying to be a little bit more aggressive with, and you're willing to own the stock. Now, let's say if the stock goes higher. Well, once again, one of the frustrations of being a covered call seller is that if the stock goes up too much, you don't get to participate on the upside. So with that, we have nothing hindering the upside on this trade. One of the things that you could also do, let's say that the stock goes from 21.10 to 22.50. It could happen. Perhaps you can buy back this short put that I'm pointing to right now for a nickel or 10 cents or whatever the case may be. Then maybe sell another September call at the 23 or 24 level as it goes up, and you've legged into a very inexpensive bull call spread, or possibly even a free bull call spread. So once again, it's just kind of based on what works best for you and your own individual situation. The reason that we like the calendar combo as much as we do at Know Your Options, 2 reasons. Reason number 1, flexibility. But reason number 2, you're actually able to take advantage of the time decay and put it in your favor from the standpoint that the time decay on the short puts in the front month will decay at a rate greater than the time decay that you are long in the long calls. So to give you an idea of it, if you have 2 options, option number 1 and option number 2, option number 1 expires in 3 days. Option number 2 expires in 100 days. And this is one of my favorite examples. Between today and tomorrow, assuming all other factors remain constant, option number 1 will lose 1/3 of its time value. Option number 2, on the other hand, only loses 1% of its time value. So with that in mind, you're able to take advantage of that difference by selling near-term premium and buying long-term premium. Once again, though, it's all based upon risk management, and that's something with which you need to consider when making any trade, not just one of these calendar trades. Now, you guys should be seeing the PowerPoint slides again. A little bit about our philosophy at Know Your Options. We'll open it up for questions momentarily. We do typically prefer stock investing or ETF investing for natural gas and oil exposure. Here's some of the reasons. Contango is one of the biggest reasons. If you look at the futures contracts for natural gas and oil, you'll see that they're priced greater and greater the further out they go. And the reason for that is because of storage costs. It's not free to store oil, so it's something with which you need to be aware of. Like investing in companies and counting on good companies, so to speak, to have exposure that way. Now, don't get me wrong, I'm not against investing directly in commodities. We actually have other commodities with which we do invest directly. But in this specific spot, the stock typically works better for most of our clients. We like the ease of orders that exist. We can invest in FCG, we can invest in natural gas stocks pretty easily, so we like the ease of use that exists. Now, keep in mind, like anything, there's disadvantages to our methods, but once again, this typically fits with a lot of what our clients are doing. And also, this is a philosophy for investing and not trading. And if you said, hey, Mike, I want to be a day trader, I'd recommend doing natural gas futures as opposed to natural gas stocks if you were a day trader. But I think I've done maybe 2 day trades in my life. I think I just did them just to say that I did them. I'm not the person to talk to about day trading. Now, how do we select natural gas stocks for investing? Well, first off, we like to ask ourselves the question, is it part of FCG? And if you go to ISE.com, there's a spot where you can actually check what stocks are in FCG right now. We like to look at technical analysis a little bit. We're not too much into the technicals, but it's something with which we do look at from time to time. And most important, is the stock in line with the individual client's needs, goals, and objectives? So what I want to show you is a way with which you can actually, and actually I'm just going to tell, we don't actually need to bring up the website again. I'll just kind of tell you a little bit about how we do it, and then we can open it up for questions. But this is our process with which we like to go from start to finish of getting into an individual stock within the natural gas market. First off, I like to look at the ISE website and see if the stock is in FCG. Next, I'll look at the fundamentals. What is the price to earnings ratio? Is the company actually earning money? What are the analysts saying about it? Is this a company that actually does serve primarily natural gas, or are they more of an oil company? Different companies have different drilling techniques, so or different goals themselves. So if I want to invest in natural gas, I want to make sure that I'm investing in natural gas. From there, we'll look at an option strategy. From there, we'll look at a little bit the chart a little bit to see kind of, is this going to be more of a breakout stock, or is this going to be more of a reversal stock? What are we looking at with that? But once again, we don't put too much into technical analysis. We do to a point, don't get me wrong, but I would say it's kind of a minority in the minority as to what we actually do. Next, we'll try and figure out what strategy works the best. Does it make the most sense to buy the stock? Does it make the most sense to sell a put against it? Does this stock look a little bit overbought? Well, if it does, it might make some sense to just sell a put and be patient and let the stock come to us. Or something with which we want to be fairly aggressive with, meaning maybe we do want to leverage it a little bit, and we want to take advantage of leveraging. Or, am I muted right now?
No, you're good. Sorry, Mike.
Okay, sorry. Okay, so anyway, with that, let's say we do want to be a little bit more aggressive and maybe lever ourselves by doing this short put combo that we just showed on FCG. Well, one of the things that you can do, let's say it's working out for you and the stock doesn't move after 3 months and you get a free call option. Let's go to Candyland and assume that everything works great. Well, you can do the same thing over again, and then you have twice the leverage on it. So it just kind of depends on what you want to do with the stock. Typically, if we want to be a little bit more passive on it, but we still like it, we'd consider selling a put. If we wanted to be a little bit more aggressive on it, we would consider going the combo route. And if we're somewhere in the middle, we might just buy the stock. So that's kind of where we go with it. Now, real quick, a little bit about what we do at Know Your Options. We do managed trading and investing. Meaning if you want someone to help you manage your money, we offer that service, whether it's for long-term investing or short-term trading. We also offer self-directed brokerage accounts with added value, meaning if you want to drive the bus yourself and just ask us questions at times, maybe get an occasional recommendation, we offer that service. You would have an online brokerage account through Brokers Express, our broker dealer. And we also offer insurance depending on the state with which you live. Contact info is on the screen. We are offering a free 18-minute portfolio review. Go to our website, knowyouroptionsinc.com/free, and if you sign up for it, we'd be happy to go over any positions with which you're in and or are considering. My email address and my phone number is on the screen, so if you have any questions after our Q&A session, be more than happy to help in any way with which we can.
Hey, Mike, I just want to apologize. There is a 3-beep signal going on every 5 seconds, so I apologize to everyone. And I have a special apology to Mike. Sorry about that. Not certain why that's occurring.
Okay. So anyway, sorry about that, folks. And with that, why don't we go ahead and start asking some questions.
Questions, guys. A little bit about Mike's business. Okay, Gil has one. You say it about the diagonal trade. If the par strike is lower, you can make no more. No? You want to talk about that, Mike?
Yeah, the diagonal spread, if you buy a deep in the money call option, then it's similar to buying a stock. And when you actually sell an out of the money call option against it, you're limiting your upside. So if the far strike is lower, you could theoretically make more because it's going to resemble a stock a little bit more, but you have a greater risk on the table from the actual money that you put into the trade itself.
Makes sense? Can everybody hear me? I tried to adjust the beeping. I might have done that. Can everybody hear me?
Yeah, I don't hear any more beeping.
Okay, good. So I sorry about that.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.